Welcome to the second part of this video for the sector of the aerospace and defense sector. I have a total of 42 stocks that I'm reviewing, and we're halfway there, and I'm going to be reviewing 10 more stocks. So let's begin. I have LHX. For the positives, I have good dividend growth, consistent earnings beat, very good return on equity. Cash flow is partially covered. The reason I have cash flow is partially covered is because the way things are now for this year, we're in a bear market. So when I say partially, it's because when companies post their results, they do it in quarters, and I don't particularly go that route all the time. I like to consider the quarterly and the yearly because you want to make sure that the company is running smoothly yearly, and I don't know, that's just a habit I have. I like to see the future outlook, not only like the first 3 months, but year round. So the negative aspect I have coming up next is the high price. I think they're very high priced. Considering, like for example, if this stock is like $200, I might consider that expensive, but other people might not. So to each their own. But from my perspective, I consider this a high price. And the negative aspect, the second negative aspect that I see is the low starting yield, and it's at a 1.3. So basically, if the share price was to drop, you could have a better starting yield, and that's just the best bet. I mean, I'm not recommending that, to buy this stock, but I'm just saying this is something to learn and something to look at. When the price drops, the starting yield goes up. So that's one of my ideas that I like to do, one of my strategies, and it's just a very patient strategy to use. So I guess that's your best bet. Next up, DCO. I have consistent earnings beat, and it's a cheap price. Another good thing that I wrote good growth stock because it's a small cap. Small caps are considered around 10 billion or less in market cap. So this company, has good growth, and they have a lot of good things coming up. Negative aspect that I see: low volume on a daily basis, and the debt needs some work. The debt is around 63%. I consider that a little bit too high. The 63%, I would like to see. I usually go around companies. Fair debt to me, I mean, it's debatable, but for me, I would consider like in the 30s, low 30s to high 30s. In the 40s, that's like drawing the line in the sand. That's just like borderline for me. But once it starts getting above like the mid 40s, now we have a problem. So yeah, they need some work. If they could get into the low 40s, that would be really good. Next up, MRCY. Positive aspect, I have consistent earnings beat, good growth, and very low debt at 13% for this company. Negative aspect, I have volume, could use some work, meaning the let me say this. Okay, PE and price need adjustment. Now let me explain. Okay, so I said consistent earning beat, which is good. Good growth. Again, when I mention good growth, it's because the company is fairly new. It hasn't been around that long. When I mean around that long, I mean around 10 plus years or more. So, the company still has some growing up to do. It's still like a baby, like a child. So it has like, I give it another few years for it to fully grow. But it has potential to, future potential. Something that I'm not gonna, it's not a stock that I'm gonna look at right away, considering the market, but who knows? Maybe in a few years it can do good. And again, the volume is what affects it. The volume is the shares that are online, and the adjustment on the, I don't even know how to explain it. Volume is like it's like the bars you see on the charts, the green and the red bars, at the bottom. It just kind of plays along with the share price, and it just needs a little bit more volume. Um, the PE and the price need adjustment, like I said. Um, the price could go down, should go down actually. Now that we're in a bear market, and it's just it just needs adjusting. So next up is VSEC. So they are surprisingly good for a small company. Again, this reminds me of the one that I said before. So again, in for this video, I've been noticing smaller companies in this sector. Who knows? Maybe when I go and finish the video, they might have more smaller companies. But again, so I had DCO on the watch list, and again, this is a small company, it has potential. And now I'm talking about VSEC, and again, surprisingly good for a small company. What I did not like was it needs some work, and dividend payout isn't necessary at the moment. What I mean by that is the markets are really bad right now. We're in a bear market, so meaning everybody's willing to sell, and then the prices are going to drop, and it's going to be hard for this company to compete in a big market. And now they're a small company, so when I say it needs some work, it needs to save some cash on the sidelines, and I really think even though they're paying a dividend right now, some people might hate me for saying this, but I think they should not pay a dividend payout. I think it's like 0.5%, if I'm not mistaken. But if they do not pay a dividend at this moment, I think it'll be really, really good for them, because that way they save cash, and then this company could grow. So I really feel bad for this company, and I just see a lot of potential in this company based on the fundamentals and the technical analysis and the numbers that I have put together. So yeah, we'll see what happens. So they did not make it on the watch list. So maybe next year, maybe next year I'll review it and see what happens. Next up is Garmin, GRMN. I personally have this in my core portfolio. I don't have any shares added, but I have it on my watch list, like ready to go. Thinking of a price and all that, and just this is mine personally. So you have one of my personal picks here, Garmin. They're added to the portfolio, as you can see. I have it on my watch list portfolio, not regular watch list, which is different. Just kind of watching it, see what happens for the year, and that's all. But yeah, core. When I add something to the core, it's because they're a good dividend payout. The dividend keeps growing. The company keeps growing. They have low debt. They always have consistent earnings, and maybe one or two surprising earnings, and just an overall really good company. And if they have a few bad things, it's just very, very minor, very, very minor, that can be adjusted. They usually have strong cash flow, definitely cash flow for the year, and just a rounded company that has future growth, and as long as it keeps the course, and makes acquisitions and not sell the company, then they're good to go. Next up is AIRI. I have them as not profitable, so the company sucks. I have on the next one. Company is not profitable, so the company is not that good. Lockheed Martin is next. So I have them. They're the best company in this sector for earnings. I have them number one in earnings, and they're a dividend growing company. And I can't remember the yield they have right now for the dividend, but the negative aspect I see needs to work on their debt. Their debt is 93%. So they're paying a dividend, but they're in high debt. Now, what do I think of this? I think they need some work. Hopefully they get that debt down, and I'm not adding this portfolio, but I will add them to the watch list. And I have them on the watch list right there. Next up, GD. I wrote there, great company and it has potential for a core portfolio, but they need to work on their debt. I should have wrote the percentage of debt. I'm sorry I didn't put that. But again, another great company. It's small, still growing, but it definitely has potential. Last but not least, HEI. Great company overall and great potential and great growth. As long as this company does not sell, please don't sell this company. I hope this company does not go out of business. I put no buyout. So as long as this company does not sell or does not get acquired, this company has a lot of room to grow and definitely could definitely be a good company. So I definitely added them on the watch list. Um, so great potential. They have a lot of room to grow, and hopefully we'll see. Hopefully they survive this market this year. So on my watch list, I have LHX, DCO, LMT, and GD. Thanks for watching, and see you in the next.